Got a question for you. Would it be okay if I showed you how to get out of debt without changing your life? Well, that's what I'm going to do. Pay attention here. It's called velocity banking. Um, a strategy for debt reduction and wealth building. It's what we're going to do is we're going to use debt. We're going to use good debt to pay off bad debts. So ask yourself, how much wealth do you want to build? How much debt do you want to pay off? And let's get right into this. I like to get right into the nuts and bolts of it. So we got a exercise, a little example coming up here first off. So here's our current example. This person owns their own home. Um, they're going to get a home equity line of credit, and they went down to the bank. They got that. They can get a $27,000 line of credit at 10% interest. All right. You only have to pay the interest on the HELOC, and there's a 10-year draw period. We'll get into more of this later. But what we're going to do is we're going to use that $27,000 of equity in your house that's just sitting there untapped, and we're going to start paying off some of these junk loans here. All right. So this person has a total debt payments of $1,423. So if you add all this stuff up, comes out to $1,423. Their monthly income, $7,193, and their monthly expenses, just like gas in their car, their insurance, their groceries, they spend $5,119. Plus, you've got the $1,423 of debt payments for a total monthly expense of $6,542. All right, that gives them a positive cash flow. This is a very good scenario. Most people are not nearly this good, of 651. Makes you wonder if they actually have everything in their monthly expenses accounted for, but we'll just roll with this example of $651 of positive cash flow. So what we're going to do is the next slide here is we're going to take that $27,000 line of credit. Yes, at 10%. Just stick with me here. It's going to be fine. And we are going to knock out, here's what they owe car payment. They owe $1,400 on this car. They owe $5,100 on a credit card, another almost $3,000 on a credit card, another $22 on a credit card, and they got a personal loan of $7,206. So we're going to take all of these debts here and we're going to pay them off with the line of credit. Okay. So all these numbers through here comes up to $19,070. So that is going to be transferred from your car payments and your credit cards to your home equity line of credit. So it's not gone, but what you did here is now these are your minimum payments. These guys they're paid off, right? You do not owe these credit cards or these car payments. So you do not owe these monthly payments associated with those. So what that just did is you just freed up $1,000 every month in additional cash flow. All right. So per month, minimum payments are no longer need to be made, therefore increasing the monthly cash flow to $1,744. Remember, we had $651 from before. We just freed up another $1,000. But remember, we got that line of credit at 10%, so we need to worry about that too. The interest-only payment on that line of credit is of $19,000, so we put it all in line of credit. So we have to pay $159, and that's interest only. So what you could do is just pay the $159 and then go blow the rest of your money on boats and vacations or whatever doodads you need to do, but you're never going to get out of debt. You're just digging your hole deeper again. So let's use this to our advantage. So the $1,093 in monthly payments was just reduced to $159, but we're not done yet. That's wrong. It was reduced to $330. Sorry. All right, let's go to the next slide. So what we're going to do in the first month, our home equity line of credit balance is $19,000. I didn't fill all those out either, but stick with me here. The first month, the HELOC balance is $19,000 minus our income. So what we're going to do is we're going to take our income that we make each paycheck. If you're paid weekly, every time you get a paycheck every week, it goes straight into the line of credit. This line of credit is going to become your checking account. We used to you probably had your paycheck direct deposited into your checking account, and then as bills come out through the month, you go to the gas station and whatever your water bill, your groceries, your insurance, everything as it comes out, you write checks or direct deposit, however you want to do it, and it comes back out of your account. But what we're going to do here is we're going to knock this line of credit balance down as fast as possible. So our income coming in, all 100% of our income, all $7,000 of it, goes in towards the line of credit, but you still have to pay your expenses. So your expenses aren't changing. Those still come out, plus the interest on the line of credit. So after 1 month of doing this, you now only owe $17,000. All right, so nothing has changed. Instead of making the payments to all of your different cards, you're now just making all your payments to your line of credit. Next month, now our HELOC balance of 17 comes up top, and then you still got your income coming in, so it's going to knock it down, plus your expenses. Those don't change, but look here. This is where the magic is right here. Now your HELOC interest is only $146. It went from $159 to $146. I know that's not much, but when you're locked into these other loans, they're all amortized. A lot of times a car payment, your loan payment stays the same every month. This, the less you owe, the less your payment actually is. So the less home equity interest that you're paying right here, that means more is going to pay off the actual balance. So now our balance is $15,887. Take that up. Again, we got income of $7,000. We got expenses. Our HELOC interest still going down. 14, month 4. We do our thing. We come through, and in 4 months, we've knocked this down. We went from 19,000. We're already down to 12,600. All right. Month 5, we're doing the same thing. 12,650 goes down to 11. Boom, up, down. I just kind of did all this. You can put your own numbers in here and work the math out here too. So month 8, we're down to 6,000, and since we've got $6,000 now, remember we can, what was it, $27,000 that we had in total. So we've got another 18,500 in our home equity line of credit balance. So now we're going to tackle this car payment. So we're going to put the 12,000 in with that 6,000 that we already owe, and we're going to knock off this car payment, paying this off, which means we no longer have the $330 monthly payment, which essentially ups our cash flow by $330. So that'll drop our expenses, and we got a new expense column of $51.19. So the next month, you're going to see it's going to pop back up now. Now our HELOC balance is back up to 18,000, and our payment is back up to $154. Where was it before? We had our interest was all the way down to $64 back in month 8. But here in month 9, we got rid of a $330 car payment, and our total interest on our HELOC is less than half of that. So no brainer, we do it, right? So let's crank through. Here's what month 10 is. HELOC minus your income, plus you got to add all your expenses back into the line of credit, plus your interest, and then gets you to 14,600 up here, down to 12,700, 12,700 down to 10,600, and I ran this all the way through month 16. We're at 22, and look here, month 18, a year and a half later, your ending balance is 0, and you've got $1,394 in cash left over. So somewhere you could probably have paid this off in month 17, but you have to go into month 18 just a little bit. So less than 18 months, you paid off $31,000 of debt, and you didn't do anything different than what you've done the entire time, just making all your minimum payments, right? Now you have a positive cash flow of $2,000 every month. You started off with $650 every month. Now you have $2,000, and you have no more debt. So what are you going to do with this $2,000 now? Please don't say you're going to go buy some new trinket and get right back into debt. Let's use this to keep yourself growing. You can start growing wealth with this. All right. Velocity banking. First thing you need to do is you have to create your budget. You have to know what your numbers are. Okay. I listed all the numbers in there earlier. You have to know what you make. Hopefully everyone knows about what they make. If you're hourly and your hours change, just kind of get an average, look back at last year and see what you did last year. I know everything's more expensive this year. Hopefully you're making a little bit more money, but try to do an average of maybe your last 12 months, what you made, and just call that your income. List out all your debts. So like we did back in this page, list, debt one, car payment. You got another car payment. We got credit card one, credit card two, three. You call them Chase, call them Wells Fargo. We'll call it whatever you want. Personal loans. So list out all of your debts. List out what the payments are on those debts. It's helpful to look at the interest rates, right? Did you see how I kept this old 3% car loan? It was only at 3%. We knocked out 23, 18, 19 first. Yeah, we knocked out the 2 because it freed up $488 of cash flow. So there's a little bit of ways you can play with this, and then this is what you owe on everything, right? So then list out all your debts, open a line of credit. We'll get into some of the details of the line of credit here, but you want to make sure you have check writing capabilities and it's easily managed between a checking and a line of credit where you can pay most of your debts out of your line of credit. My line of credit pays just about everything. For some reason, my PNC credit card will not pay from my line of credit. So I pay that out of my checking account, but then I just transfer money over to that. It's not seamless, but it's pretty easy. You'll smash that and you'll be free. That's the basics of it. Going on here, why this works is because most of the time, this is a home mortgage loan here. Amortized loans, what they do is the red, you can see this is of your entire, was it 1750 payment, 1717 is the entire payment here. This much is interest. Okay, so what is it? Over 1250 of that initial payment is interest, and what is it? $400 of the first payment is principal. So the banks get all their money that they're going to make up front, and it's not until about 2040 somewhere in there where you're actually paying the same amount of interest and the same amount of principal, which is paying off your loan. And then as time ticks on, you're paying way more principal every month and way less interest. Which, do you ever notice, like right around year 5, 6, 7, that you've owned something like a house, your bank's calling like crazy? They want you to get you to refinance. We'll save you so much money. Your payments will go down. Sure, they will. And they're going to reset their payment structure, and they're going to get all interest up front. So they're making way more money. That's why they like to do that. Budget, you have to know your numbers to be able to do this. Velocity banking is not for everyone, and your budget will tell you. Take an honest look, go back over the last year's expenses, your income, and it'll tell you right there, income minus expenses equals cash flow. Not everyone has positive cash flow. And if you don't have positive cash flow, it's not a deal breaker, but we have to be able to get to a positive cash flow. If you can't take out a line of credit, or if you don't own your own house, you can, hopefully you have good credit. You can use this. You can get a 0% credit card, for an introductory period of probably a year and a half. And we can use that as your debt tool. You can get a personal line of credit. And it'll vary. Cash flow will vary a little bit from month to month. These are best guesses, but you have to know where you're at if we know we can get cash flow positive. If we can't get cash flow positive, this is just going to dig ourselves a deeper hole, and it's going to be tougher to ever get out of it. So pick your debt tool. I touched on this a little bit. A home equity line of credit is probably the best way to go if you own your own home. If you've owned your own home, right now it's July of 2024. I'd say if you've owned your home for probably 2+ years, you probably have equity in it with the market right now. If you bought back in COVID or pre-COVID, you should be sitting pretty, and you should have equity in your home, meaning if you bought your house for $200 and it's worth $300 now, now you have $100. That's $100,000 of equity you have against your house. So if you were to sell your house, you would have you could sell it for $300, but you would have to pay off the $200 that you owe, and that's your equity. So you can get a line of credit against that equity, which means if you don't pay this line of credit, their bank is going to come take your house. So got to be serious about this. Personal line of credit is about to say it's a line of credit. The interest rates are usually a little bit higher. You can go down to your bank, but even this, in our example, I used a 10% rate on the home equity line of credit. Mine right now is at 9%, but I wanted to show a big number. Everyone's like, well, why would I do that? Because my this loan and my that loan is only at 4%. Why would I get a HELOC at 10%? Well, I just showed you. Credit card can be done, like I said, but that's the last resort. Velocity banking, this is a tool. I cannot be more, I don't know how to be more clear than this compared to a shovel. Shovel can be used to cultivate a beautiful garden. It can also be used to kill somebody. All right. If you can't use the tool properly, don't use it. If you're going to go out and smack people over the head with your shovel, don't get involved in this. At some point, you're going to get caught and it's going to go south for you. So if you go back to this example and you just paid off all this money, and we just paid off all this debt, and now you're seeing that you've got an extra $1,000, and you go out and start just racking these credit cards right back up, you're just going to be right back. These numbers are going to be right where they were, if not worse. And now you have to pay. Not only are you back where you were paying these, you still have to pay on your line of credit too. So don't do it. You got to be disciplined and do this right. Revolving line of credit. When you go to the bank and you've got equity in your home, most bankers are going to try to push you to a home equity loan. They're going to say, oh, home equity loan is a lot cheaper. I can get you a home equity loan at 8%. Why would you want a home equity line of credit at 10 or 12%? That doesn't make any sense. That's not what you want. That's like going to McDonald's and you're ordering a Big Mac and no, you don't want a Big Mac. You want a quarter pounder. No, I want what I want. I know what I want. And you do not want a home equity loan. You want a home equity line of credit. Must be able to make multiple principal payments each month. Some banks have weird issues with their lines of credit. It's not a deal breaker if you can only make one payment, but the one I've got, I get paid every week. I get my paycheck gets deposited into my checking account, and I have to go to online banking. And as soon as it posts in my checking account, I transfer it over the entire thing to my home equity line of credit. It's a little extra. You do have to do a little bit of work, but it's a minute a week, so it's not bad. Must have check writing capability with no or high limit of transactions each month. So I pay my water bill. I write a check I have an actual physical checkbook that has a routing number and an account number, and I can write checks to pay my water bill from my line of credit. I can pay a lot of things online. My Capital One credit card bill, I gave them that routing number and account number, and it's easy. I pay my credit card bill on that every month. Interest only payment period, you want that of at least 5 years. I've seen some that have 30 years of an interest only payment. At some point, whatever that is, they called it your draw period. If it's 5 years, after 5 years, now you can't take any more money out. They make you start repaying that loan. But we are going to have, as long as you got at least 5 years, we're going to be good. We should get, in most cases, I've seen just about everyone can get out of debt in 5 to 7 years. So if you can only draw on it for 5 years, you're going to be so much farther ahead. After 5 years, you just go back to the bank and you renegotiate. You show them that you're paying it back, you're paying it down. They'll usually probably renegotiate that and open it back up to you. Online banking access is very convenient. Debt acceleration, make multiple principal payments to reduce your balance. The lower the balance, the less interest you pay. We kind of touched on that already. How it works. You got to know your budget and your cash flow. The more cash flow, the faster this works. What we're doing is we're creating more cash flow. So list out all your debts, the amount owed, the minimum payment owed, and your interest rate. Use the debt tool to pay one or multiple debts in full. Once you pay that off, you no longer have to make those payments, and that ups your cash flow. And that is all we got. So I tried to keep this quick and dirty, about 20 minutes or so. Hopefully you enjoyed, and let me know if you have any questions. Can't wait to help you guys out on this.